Imagine getting a dividend payout every month just for investing in some of the world's biggest companies. Now imagine that paycheck continually grows every month and is taxed less than regular income. To me, that sounds pretty dang good. That's the idea behind SPYI. It's a unique ETF with a 12% yield that's been gaining a lot of attention from investors looking for both income and growth. In today's video, we're going to discuss the three main reasons why I invest in SPYI and why you might want to add it to your portfolio. If you're new to dividend investing, this ETF might actually be the perfect addition to your portfolio. But before we get started, welcome to the channel where we discuss how to grow our portfolios for the ultimate portfolio payday. Just remember, I'm some random dude from the internet, so make sure you always do your own due diligence before you invest in any stock. The stocks we talk about here may work for my own portfolio, but they might not work for yours. So let's get started. The first and my main reason for investing in SPYI is the consistent, steady dividend income. It's built for investors who want repeatable cash flow month in and month out. So let's take a look at the distribution payouts for SPYI. Unlike a typical S&P 500 ETF like the SPY, which pays dividends once a quarter, SPYI pays you every single month like clockwork, and they've paid consistently over the last few years since they've created the ETF. So to this day, the income has been consistent with their payouts, ranging from 45 cents to 52 or 53 cents. Now you may be asking, how do they do this? It's because they use a process called selling covered calls to generate cash flow. In plain English, it rents out the stock it holds by selling call options, and it pockets that rental income, so to say, which gets passed down to you as the investor. At the time of this recording, SPYI's yield is around 12%, which is huge compared to the regular S&P 500, the SPY, which usually pays about 1.2%. And because you're getting that income monthly, it's easier to plan for whether you're reinvesting it, whether you're letting it compound, or actually using it to pay bills. I myself am currently reinvesting the dividends and letting it grow. Now let's take a look at a dividend calculator and see how my SPY investment can potentially do in the future, in a perfect world, when you reinvest the dividends. All right, let's take a look to see what this portfolio of mine will be in 25 years when I am ready to live off the dividends, or maybe sooner, but 25 years is my goal. We have the SPYI name here, the ETF name. I currently have 60 shares invested. The distribution is monthly. I am buying one share a week, so roughly $50 a week times 4 a month is $200. 12 months is $2,400. We're doing a 15% dividend tax rate because it's long term, 25 years invested for my goal. And we're going to be conservative here with the share price appreciation, but ultimately these numbers look pretty good. So after 25 years, we're looking at roughly an annual dividend of $62,000 a year, and the balance of my portfolio should be roughly $563,000 in a perfect world. Obviously, we didn't touch anything here for the dividend amount increase annually or the share price, but just being conservative at the current rate that I'm investing into this ETF, if the 12% plus yield holds, then this will be what I'm looking at near retirement age. When you reinvest those monthly dividends, automatically you're compounding your returns even faster over time. So whether you're looking to build wealth, retire early, or just have extra cash flow every month, SPYI's income feature is a very serious advantage to owning this ETF. So we know SPYI is great for generating income and cash flow, but what about growing your investment over time? Here's the thing, SPYI doesn't just sit in cash or bonds, it actually invests in the same large blue chip companies that make up the S&P 500. Let's take a look at the companies that make up this ETF. So now we're on the NEOS homepage for SPYI, and we're going to take a look at the current holdings for this ETF. And as you can see here, we've got Microsoft, Nvidia, Apple are all roughly 6%, almost 7% for Microsoft. Then we've got Amazon, Meta, Broadcom, Alphabet, and then Tesla, Berkshire Hathaway, and Alphabet, Google again, rounding out the top parts of the portfolio. So obviously, the SPYI ETF is invested in the top biggest companies in the world, just like the SPY. Historically, over the last 90 years, the S&P 500 has an average annual return of about 10%. So SPYI gives you exposure to that long-term upward trend. Now, one thing to understand is that SPYI uses covered calls. It's a little different than buying the SPY outright. Covered calls basically caps the upside when the market is going crazy because you're selling the right for someone else to buy your stocks at a set price. If the market jumped 30%, you might only capture 12 or 15% of that. But also, in a flat and choppy market, SPYI remains relatively stable. And because you're capitalizing on growing that income every single month that you're collecting from dividends, while other investors are just sitting around waiting for the stock price to recover. So if you're the type of investor that looks for steady, reliable growth, not crazy, volatile markets, SPYI could really fit nicely into your portfolio. You're still growing your wealth, but you're just doing it with a smoother ride and a lot more dividend income along the way. Now here's a hidden bonus about SPYI that a lot of people might not realize, and it can make a big difference over time. That brings me to the third reason why investing in SPYI is very beneficial. SPYI doesn't just send you taxable dividends every month like most stocks or ETFs do. Instead, a big part of the payout is classified as something called return of capital, or ROC for short. What does that mean for you? Instead of paying regular income taxes every year on your entire distribution, some of it simply lowers your cost basis, meaning you don't pay taxes until you eventually sell your shares. Let's say you invest $1,000 into SPYI. If you get a $100 return of capital, your new cost basis is $900. You don't owe taxes on that $900 only when you sell. And if you hold SPYI for a long time, you're basically kicking that tax can down the road, letting your income compound faster. Plus, when you do sell, you might qualify for the lower long-term capital gains tax rate, which is a lot less than ordinary income tax. Bottom line, SPYI isn't just handing you income, it's handing it to you in a way that could make you more money by keeping more in your pocket. And over a few decades, that tax deferral can seriously boost your overall returns compared to a traditional high dividend stock fund. So with SPYI, you get steady monthly income, potential for long-term growth, and smart tax efficiency. Here's the thing. By no means is it a perfect investment. No ETF really is. But if you're looking to build wealth and cash flow without taking on huge risk, SPYI definitely deserves a spot on your watch list. If you found this video helpful and are interested in this kind of content to help you build your passive income and retirement portfolio, smash the like button, subscribe for more investment analysis, and comment down below. Do you currently invest in SPYI? If not, are you planning to? I'd love to hear your thoughts. Until next time, have a great one.